Alright guys, let's discuss in this charting session a rare A+ setup that is a real money maker when it comes around. So let's just jump right into it. Now, the kind of price action that you see in this 1 hour time frame is precisely what really piques my interest for high probability trades. I want to explain why I would consider such a trade. That way, the next time you spot a similar setup, you'll have the confidence to consider it as a trade opportunity. So the first thing you want to look out for when the market starts moving is to basically analyze four key factors. First up, you got to define that trading range in terms of getting a handle on where the market is operating between the highs and lows. Next, see if the market is on the hunt for liquidity. As you know, liquidity grabbing is the favorite sport of market makers. They will often poke around certain price levels, trying to get those resting orders to get filled. Once they get filled and markup or distribution phases start emerging, then we know that retail has been stopped as the smart money starts to enter their positions. Then keep an eye out for if the market is rebalancing itself after any inefficiencies or imbalances built up over time. Make no mistake, the market will always try to correct and even itself out. Last but not least, check if the market is straight up just trying to find a new equilibrium point between buyers and sellers, which is obviously the tug of war between supply and demand forces. So if you can get a beat on any of those four factors, the range, liquidity grabbing, rebalancing, and equilibrium seeking, you'll be in a much better position, in my view, in terms of understanding what this whole market movement here is showing you. Now, just by eyeballing this chart, I can tell that trading in this specific area is probably not the move. Why? Well, because as you already know, sideways moves more often than not don't really have a clear market structure going on. That's why that should be avoided. Instead, try trading between supply and demand levels, as this is where you'll see, or when you'll see, price expansion or the most clear price movements. So by defining the range and filtering out these choppy sideways moves, while also considering one of the four factors I mentioned earlier, specifically spotting areas where the market seeks balance between buyers and sellers, we not only have identified a key area of interest on this chart, but have now also put ourselves in a much better position to find that high quality setup that can guide us towards a solid entry point. So what we do next is basically we try to identify the manipulation aspect within this price movement, which in this case starts with this reversal at the top of the range. Now, how do we recognize this as a manipulation? Well, the establishment of a supply zone up here as price keeps puking lower after, and this is important to remember, guys, after dipping below the zone's base with a massive impulsive move, serves as a clear indicator of manipulative actions by smart money. So now that we have pinpointed the manipulative move, the next question is, well, where will the right expansion balancing move take place? What this suggests is that when the market shows any form of imbalance, particularly significant ones like these 150 or 250 point imbalances, it's inevitable that it will seek to correct itself and obviously regain equilibrium. However, the next critical question then becomes how do you determine the right moment to enter that rebalancing trade? The reason you should pose this question is because when you look at the progression of this trading range, while it may have been possible to rake in some great points by entering at the bottom, as we shift here, this partial rebalancing move by the market would have been more of a lucky trade rather than a high probability, well-structured trade setup and entry point. The same goes for this downward action around the 1030 mark. And yes, obviously we had this blow-off move over here trying to bridge the supply zone. So the argument after the nosedive can be made that that's what we could have had a really great short. Well, I would argue with that point because in the context of of the establishment of a supply zone, this wasn't a true rebalancing move that would have presented us with the right shorting opportunity. Look, guys, you have to remember it's the candles that usually tell the real story, not those wicks. They are the ones, meaning candles. They are the ones revealing the true narrative here. Second, besides the fake mini breakout of this internal range, we just didn't have enough structure yet to validate a short bias at this point. On top of that, even that blow-off move we saw, even that didn't quite make it in terms of price printing inside the base of the supply zone. The bottom line here is that we can be bullish, we can be bearish, but until the market itself validates those assumptions with some real structure, you just can't take a trade. I mean, it's just as simple as that. And again here, and I don't mean to be repetitive, but you can have all the biases you want, but if the market doesn't confirm it by showing you that structure and following through, you're just gonna be guessing, and guessing gets you it doesn't get you anywhere in this game. It's a self-destructive behavior basically in this game. So as tough as it can be sometimes, you gotta be patient, read what the market is actually telling you through that price action. Also you have to wait for all of these things to line up with your bias before pulling the trigger. No shortcuts around it. So after this sequential lows down here that clearly mark the bottom of the range, the only logical entry point for me is after this demand zone gets underway via this fast impulsive move out of the base. What that means is that after breaking formation and undergoing a bearish shallow retracement here, the market doesn't hesitate to surge upward. In fact, as you can see from the chart, it surges upward strongly, transitioning right into the base of the supply zone. Now that's important. At this point, given my understanding of the A+ model, a bearish bias on this time frame becomes a no-brainer. It's just a must at this point. At the same time, guys, I do understand that it might be a bit confusing to remember all the key elements of the model when watching the video for the first time. So let's recap them. Firstly, we have a well-defined supply zone. Secondly, the manipulative process following the formation of such a supply zone has clearly here been recognized. Thirdly, an upside move, which is another manipulation within a manipulation, has been identified, this time driven by the formation of a genuine demand zone. And at the same time here, supported, which is important, supported by a break in market formation or market structure. It's worth noting here that the emergence of the demand zone within the same trading range as the supply zone acts as a counterbalance to it, meaning the supply zone significantly enhances, in my opinion, the overall trade setup, transforming it into a rare A+ opportunity. Lastly, a strong repricing or upward move leads to the breach of the supply zone, providing us with the entry point we have been seeking and restoring market equilibrium in the process. And now this confluence of factors totally aligns with the model, giving us a solid bearish opportunity once price enters the supply zone. Obviously, that's where you should short the bejesus out of the market, always with a stop loss in place. Also, depending on your trading style, you can certainly use the 1 hour time frame for identifying your entry, or opt for lower time frames if you prefer a more detailed, fractal based approach. It's totally up to you. By the way, guys, if you are interested in a deeper dive into supply and demand strategies and trades, make sure to watch this video next. Alright, gang, thanks for watching, and as always, hope to catch you all in the next one.